Welcome, everyone, to GlobalView. My name is Antonio Martinez, and I'm the head of Americas and Global Economics at Frontier View, a fiscal note company that is part of the Global Intelligence Business Unit. We work as a trusted partner for 300 multinationals, supporting VPs of region, CFOs, and strategy leads. Our focus is empowering strategic planning and market monitoring to drive growth and profitability at these companies. We have dedicated research practices for North America, Latin America, Asia Pacific, Europe, Middle East, and Africa, as well as working with various verticals, including in the consumer, healthcare, technology, and industrial space. Today, we will be discussing the outlook for oil prices with Martin Belchev, our head of Europe and Commodities Research, who will be walking through our latest perspective on the oil markets and the risks to our price forecast. Martin, thank you so much for joining us today.
Thank you.
So the first question I have for you is, maybe it's to set everything up. What is essentially our main expectation, your main expectations for oil prices for the rest of this year and into 2025?
So as part of our base case, we expect oil prices to be around $87 per barrel for 2024 and at around 83 to 84 in 2025. Now, with that being said, however, there is quite a lot of volatility and quite a lot of factors interplaying in how these oil prices really play out throughout the rest of this year and again to 2025. Hence, why we've developed scenarios based on supply and demand and geopolitical dynamics. So, for example, we have, as a part of our lower price scenario, $83 per barrel, and as a part of our higher price scenario, $91 per barrel for this year, with the respective probabilities attached here. Now, I also want to mention that given what we've seen the last month, we've also increased the probability of our lower price scenario, really again based around these supply and demand dynamics. And that's really a good reminder for multinationals of why the scenario planning is useful and how these can inform strategic making decisions and pricing making decisions going into next year as well.
Okay, so that makes a lot of sense, but what are the main drivers behind these expected or potential price movements?
So as part of our base case, we expect supply constraints to remain in place. First, frankly, OPEC cuts remaining in place as well throughout the rest of the year. We've seen actually OPEC being a bit more coordinated when it comes to not only the announcement, but also the implementation of these cuts. While US production has, in fact, grown substantially throughout last year, gains are not as acute as they were in 2023, and we're seeing relative lower growth in terms of capacity. On top of that, we expect the fact that global consumption will actually accelerate at the second half of the year, especially given stronger growth in Europe and the US, and a bit of a pickup in demand from China, also resulting in a bit of a stronger demand that should lead to oil prices stabilizing. And as a part of that, actually, you can see our 2024 forecasts for market share. We see actually OPEC plus market share for this year dropping just a bit, again, based on the fact that we're seeing OPEC cuts being much more stringent than and much more coordinated and disciplined, really. And the fact that US production, again, has increased in 2023, and we still expect some gains in 2024.
So is that what's driving maybe some of the recent drop in oil prices? Because you're pointing to a lot of potential upside around the demand story. Is that reflected on our oil price view? And does this require any change in outlook more generally?
So the recent drop is based on a few factors. The first one being that the data that's coming out of Asian markets not as great as we initially expected, which has resulted in markets really adjusting their demand expectations. We still maintain the demand expectation, demand for 2024 is around 102 million barrels per day. But really, what's worth looking out for here is that how these demand drivers playing out. Additionally, the fact that we've seen the Fed's delaying cuts, responding to accumulated inflation, is also feeding into this story where we've seen markets react relatively quickly. And additionally, we're seeing actually some easing in the risk premium stemming from the ongoing conflict and tensions in the Middle East. We're still expecting demand to pick up more substantially, and that should pave the way for this stabilization and a bit of an increase in oil prices. But because of these decisions by the Feds and because of, again, a lot of uncertainty surrounding global demand dynamics, this is the reason why we've actually increased our lower price scenario probability. Should we see really demand underperforming, especially when we talk about China and Europe, and should we see additional uncertainty surrounding these rate cuts, that will lead us closer to that lower price scenario.
So obviously that's could be a positive and negative depending on the market we're talking about here. But obviously when it comes to oil prices, the geopolitical element, the impact of risk, potential impact on oil outlook, what's our expectations around what impact, say, some of the conflict in the Middle East or between Russia and Ukraine could have on our forecasts?
Well, there are two major issues here. The first one is that we're still accounting for some disruptions when we talk about Russian supply, mostly stemming from Ukrainian attacks on Russian infrastructure. These are fairly difficult to predict, obviously, and they have an impact on the short-term movements. And we've seen markets actually in the most recent series of attacks on Russian infrastructure actually reacting quite quickly to that. Even though Russian oil has been under sanctions and there is a significantly big gap between Urals and Brent, that existing supply is still a relatively important factor when it comes to headline Brent prices. When we talk about the Middle East, obviously, again, a lot of uncertainty surrounding that, but we have seen, as things haven't really escalated, a bit of a drop in that risk premium. But the main takeaway here is that things can get quickly out of hand, and any escalation really in Gaza or by the Houthis can have a significant short-term impact on these price movements. Hence why volatility is definitely something to be on the lookout for.
Well, thank you. You've left us with a lot to think about across, as always, when it comes to our oil outlook. Thank you, Martin, and we look forward to hearing more about what your commodities research team comes up with over the next few months. Thank you, everyone, for joining us for this edition of the Global View, and looking forward to seeing all of you 1 month from now.